Let's transition into our new guest, George Marcus, CEO, founder of Synergy Point Alpha. SynergyPointCA.com is the website. George, welcome to the show.
Thanks, Michael. I really appreciate you having me on.
My pleasure. All right, you've got some interesting stuff. Let's get some background on you. From you personally, what does Synergy Point do, Synergy Point Alpha do? And then I'm going to drill down to a few questions for you.
Okay. I've spent most of my career, it's been the better part of 30 years now, in derivative products, looking at ways of adding alpha to existing strategies. And about 6 years ago, I had an idea, and the idea was, and it related to indexes that now exceed stocks in the world, about their caps and how you could try to outperform an index cap. And so when we looked at that idea, it was really a relationship between beta, alpha, passive, active, trend-based, mean reversion, investing versus trading. And we looked at that as sort of the circle of things that would allow you an opportunity which wouldn't interfere with the core asset. And we created a model which we've now tested for 6 years, and it's an 85-15 split. It really doesn't matter what the trend-based side of the trade is. It's more about how to add what we call a pure alpha strategy to generate more returns. Our model has done very well. I mean, it's not a home run hitting type of model or a sinking ship type of model. It sort of works within I would say, a -6 or 7 to a +12 range of performance. And it's performed rather well. And I would argue it's rather simple in what we do, but very effective.
All right. Talk to me about a way to unlock the passive index cap. Drill down to that for the audience.
Okay, so let's just take an example of an index bond fund. And you have a weighting of, let's say, 85% of the bonds and then 15% of the active alpha strategy. And what we tend to do is it's a long-only option strategy. We use the G10 cross rates, just the depth of liquid, no slippage in the trading and the rest of it. And we balance it out as in a bell curve strategy, so we're equally weighted on the put and call side. There's no naked open positions. Again, I've tried to keep it as simple as I could. And then it's how we've defined the time frame risk and the volatility risk that ends up generating return.
Now, what about a pure alpha strategy? Not a hedge or beta asset.
Okay, the pure alpha. What we mean by pure alpha strategy is that this is not about hedging your beta assets. No, in fact, it has to stand alone. We thought that was a really important feature. In my career, I found that a lot of times when you're using hedging beta assets, that it's very easy to make a mistake on the hedge, and you end up selling the asset for less than it would have been if you did nothing. And we found that was always a big pushback in the past. And so when we looked at this product, we thought, okay, we wanted to eliminate that risk exposure for a passive investor. And this is where, so in the pure alpha side, it really has nothing to do with the hedged beta asset. And I'm not saying an investor couldn't hedge his own beta asset, but we're saying, well, we didn't want that relationship in the balanced approach of the passive active strategy.
How does it complement any trend-based asset?
Again, it's the idea of the non-correlation
right.
of the trading. So the complement. I mean, the four things that I described. The whole. If you put what would you want if you wanted something that was non-correlated, and we think that those are the real issues with non-correlation. So for me, I think that's the complement part is that it doesn't interfere. And that if you're trend-based, you believe in the assets that you own, you really don't need. You can participate in market volatility without risking anything as it relates to the trend-based nature of the asset investment.
All right, so now you're long only a put-call strategy, and you're focusing on G10 currency. So describe the cross-rate options.
How it works, I think, I just want to scroll up to one thing in my pitch just to make it easier for everybody to understand. What we looked at when we put this together was the idea of a bell curve, and that you had to perform within what would be considered a normal volatility of a cross rate. So if we take a look, let's say for example, euro dollar, if you looked at an average monthly bell curve volatility, you're looking at about 3.5 cents, which would mean this is on average. Sometimes it's a lot more, sometimes it's less. And so the idea would be that in that it could be 1.5% up, 2% down, or vice versa. It didn't matter. So your trading had to be able to generate a return within that volatility. And the average volatility we require to generate our monthly returns is 1.75. So we felt that the natural volatility, we were well within a performance area based upon what the normal or the average volatility. I don't know if that makes sense to you, but certainly made sense to us.
George, let's do this. Let's take a break right now, come back on the other side, and we'll start in talking about your beta, your alpha balance, the 85-15 that you mentioned earlier, all right?
Yep.
All right, we'll be right back on the other side of this break with George Marcus, CEO, founder of Synergy Point Alpha. Welcome back to CEO Money. I'm Michael Yorba, your host. We're talking with George Marcus, CEO, founder of Synergy Point Alpha, synergypointca.com. All right, George, welcome back to the show.
Thank you.
You're welcome. All right, let's get into the balance here in the portfolio. 85-15%. How does the weighting work? Describe. Because you've got to get out of some of these options on one side or another, and the timing on that to create the alpha that you're trying to get. So
yeah, I think you have to look at it more in the sense of the mean reversion add-on and the trend-based investing, and that the idea that the payout participation really works in both ways. So I've often said that this is like trying to create a bull-bear strategy, that you were never trying to call the market. You were just trying to understand volatility and time frame. So traditionally, or I shouldn't say traditionally, but the way it basically works is that obviously if you put a put call on same strike price, one side will perform and the other will lose.
Right.
What we found was that 90% of our profitable trades tend to come where one side of the strategy is exited within, I would say, 5 to 10 trading days. Our usual time frame is about 40 days. And so what you're doing really is you're allowing the one side which the market moves in to be the profitable side, and then the losing side, you're allowing that to really have the longer effect of the time frame. Generally, we never take a position bigger than 1.5% of the portfolio. Our average has been 1.39. So when we get a move, let's say in our 1.5, we'll often get a move up to 2.5, which will mean that the losing side now has a risk exposure of anywhere between 0.3 or 0.5. And so it really relates to how that part of it does in the remaining time frame. What normally would happen is if we have a quick bounce back, we would just clear the positions out and restart an unequal put-call strategy in the cross rate. If it's a slower effect, we may find that it's better to just reestablish the other side. In other words, if you get a bit of a movement, let's say if it went down, we covered our put, we're long a call, you get a bit of a rally, we would look either at reestablishing the put side or just covering the other side. And you're just netting out what the difference is between what you sold the one for and what your potential losses on the other, or you're repositioning with the position that you covered, and what you're again looking for is a reduction in the risk exposure relates to the capital with as much time frame as you can muster at the particular point of reestablishing a position.
What about being adaptive to changes in market volatility?
I wouldn't say that's a big issue. That tends to be more if you're trying to a trend-based idea that you're trying to call market volatility direction. I think the way, again, and we've averaged about 9 trades a month in doing this, and over 7 years, I wouldn't say that we've really spent a lot of time looking at the underlying volatility of the cross rate. We've been trying to be disciplined in a way that we're really not trying to call the market. And so it's more of almost a pedantic move where you're just saying, okay, we can now either cover the losing side and we net out a profit, or let's put the winning side that we've covered back on, and we're just really concerned about time frame and volatility. And the volatility, we would look at it more that when you have low volatility, the size of a position is larger. When you have high volatility, the size of a position is smaller. But because you're netting them out each way, the impact of the volatility isn't one-sided. So it's not, and for us, we don't find it as meaningful an issue in the sense of trying to determine what action we should take in the trade.
Okay, all right. What about your sub-advisor structure?
What we started this out, we were really anti-back testing. And so how we started the program was through an advisor relationship here in Toronto. And the idea there was that we would just manage or consult on the trading to build a track record out. And we felt that was the best way of getting the managerial experience of doing it rather than just, like most people do, say, I backed into this model for 6 years, it works perfectly. Mm-hmm. Any of us who have been around long enough realize that the impact of the market and the emotion and fear generated by volatility, it's not a great idea just to think you can backtest something and make it work. So we're pretty comfortable now in the time that we took to truly understand it from an active management perspective. And we're just now beginning the idea, okay, what about a fund? And we're in the process of a few discussions of seeding a product. We're thinking of probably more a bond product. We see that as probably one of the more interesting areas to be involved in with the program, simply because you had historical lows in interest rates and the idea that the intermediate long end of the bond market is really risky. And so the short end, if you could add alpha to the short end of the bond market, you probably would have a winning strategy as rates begin to climb by increasing the yield on the trend-based part of the investment, as well as then the mean reversion part of the investment, generating the alpha for the underlying asset.
All right, well put. We've got to run, but George, thanks for being a guest on the show. How do people reach you so they can investigate this further?
Just our website's pretty simple at this point. Just go there, click on it. There's actually an 800 number there to call. I also have my associate, John Mangano in Boston, who handles most of this for me. So if you call, he'll probably connect with you, and we can push it forward from there.
Great. Thanks for being the guest, George.
Thank you for having me.
You're welcome,
Goodbye.
George. You're welcome. George Marcus, CEO, founder, Synergy Point Alpha, synergypointca.com.